Okay, before we get into the meat and bones of this video, which we are going to discuss what could come tomorrow, some of the leaked data that may have occurred today. Yeah, we'll talk about that more later on. But some news came out today that really negatively impacted Tesla. Tesla's chief information officer, Nagesh Sawhney, leaves Tesla just days before the robotaxi event. It says here, Chief Information Officer Sawhney is leaving the company, Bloomberg reported Thursday, citing people familiar with the matter. Sawhney helped in the build-out of Tesla's new data centers in Texas and New York. Two people were quoted as saying, the company has been increasing its compute capabilities to augment autonomous driving. Sawhney's departure comes days before the company's launch of a new robotaxi. There's not a lot of reasoning provided for this. We don't know exactly what this is for. I do think this is not the greatest news, but it's also not the worst news. I mean, it's not, we've seen worse, okay? Like the CFO stepping down, right? We've seen worse out of Tesla in recent months. So this did have a negative impact to Tesla stock today, but it's not the biggest deal. Here in this video, I'm going to play this clip from CNBC that says, expect a sizable volatility event in October. Because secretly, big money is actually preparing for this. And by the end of this video, you may be flabbergasted by what could come to markets. Because at the same time, Wall Street is telling you you need to be long this market, buy this market, raising price targets. They're secretly actually trying to protect their portfolios for downside. And there is a major event coming tomorrow morning that we will discuss in this video as well, which I'm sure you already know what that is. That is the non-farm payrolls and the unemployment rate.
So right now you're looking at S&P futures. You say they broke through a key support level. Spell it out for us. Walk us through the chart. We made it. What are you seeing in the chart? What's that key support level and what does it say to you?
Yeah, I think when you're looking at the S&P futures, that's a December futures contract, and it broke down below 57.80. And that break below there was sort of this pattern where, we had such a huge run up from August. We had a little bit of a volatility event occur, that yen again, get 'em kind of action where people unwound the yen carry trade. And then the market rose and has kind of been topping out here. It broke below that 57.80 level. And so that's one area I'm looking for. We really haven't been able to get back above it. And as you see the futures trading lower, as you mentioned earlier today, this morning, that's a little bit of an indication that we just really can't get above there. So I'm a little bit cautious until we get above that 57.80 level.
So just to be clear, that's in your mind a bearish signal.
It is. And this kind of little pattern is almost a mini head and shoulders top. It's not like a wide range that a lot of technical traders look at. But when we're looking at a 5-minute chart and what's going to happen short term and this little increase in volatility here to start October, to me, it's a little bit of a bearish move here. And that 57.80 level was really a critical level that we broke below. And so I think now the pressure is a little bit to the downside in the near term right now.
What about the pricing when it comes to downside protection? Has that significantly increased? I mean, we have had a lot of big macro events just in the last recent days.
Yeah, we have. And you laid out the weeks ahead here and all the events that we have going on, geopolitical and whatnot. And we have started to see put traders in the S&P 500 start to uptick the premiums that they're willing to pay relative to calls on the upside, right? So a put is a protection to the downside on the market. And we've seen a heightened level here over the last, let's call it month or so, where basically traders are trying to buy more protection to the downside than they really want to the upside. That trend completely reversed. Really, for the last 2.5 years, it's been the other way around, where we continually saw call buyers come into the market, any kind of dip in the market. Traders were in there trying to buy the upside call. The reverse has really happened over the last 2 months, and that's a little bit concerning that institutional traders are out there wanting this protection for the downside. But look, obviously, a lot of geopolitical tensions out there in the atmosphere, an election coming next month, couple that with another Fed meeting at the beginning of November, 2 unemployment reports really in the next month, if you consider this Friday and the week of the election week. So, and Brian, then couple that with earnings, a lot of volatility to be expected.
I don't want to interrupt you, but you're spelling out, I think, the next question I want to ask you. What's the options market telling us about these upcoming events? You mentioned it just about a month away. The election's coming up. We have big jobs reports. We have a Fed meeting. I mean, what is the options market telling us about all that?
Well, when we look at the level of volatility where the VIX is at, I'd expect over 1% moves in the market back and forth on a daily basis. Now, we saw that a little bit to start October. We haven't really seen that the last couple trading days. It's kind of hung in there. I think it's waiting to digest the unemployment report coming out this Friday here, and then maybe make a move here. But certainly expectations are heightened that we're going to get a fairly sizable volatility event or move here coming up in October.
All right, what about the NASDAQ futures? I thought there were some interesting moves there. Kind of spell that out for us as well.
Yeah, the NASDAQ is sort of interesting, right? Because when sort of the yen carry trade unwound a bit in August, we obviously saw a lot of selling pressure in the NASDAQ. Sort of, it seemed like people were moving out of risky assets, heading into that 10-year note, the U.S. Treasury market, and the NASDAQ had some selling periods. And then all of a sudden it rebounded right back, really here, that 17,000, 18,000 level, I should say. And now it's kind of also stalling out a little bit. So that's something I'd be a little worried about, that we get this carpet shakeout back to the downside, some sort of retracement back towards those lows that we saw back in August. Maybe not all the way down, but something where the market's looking for a little bit of a pullback.
So let's get this straight. The whole time Wall Street is raising price targets, telling you to be in this market, be long as all hell because the Fed is cutting rates and we're heading for a soft landing. Meanwhile, they're actually trying to protect their portfolios for the downside. We kind of already knew this because the VIX is elevated, and it really has been elevated over the past month or so, but it sounds a little different actually hearing that. You can see the VIX was actually up about 5% today, and the VIX is sitting at 19.80. And you've climbed recently. Ever since September 26th, you were at about 15. You've climbed up to about 20 now. So really in the last week or so, there's been this rush to buy protection on portfolios. But the VIX has been elevated ever since really mid-July, when it went from about 12 up to 16, back down to 15. 15's been kind of like a base. And now you're on another upside breakout of the VIX. This basically just means, as you heard from that clip, people are willing to pay more for downside protection than upside protection. Okay, yes, there's a thing as upside protection. That's why calls are a thing, so you don't miss out on upside. Wall Street's just paying more for puts. Now, what the VIX also tells you is it's kind of a velocity measure as well. When the VIX goes up, that means there's more puts being bought than calls. That's damning. And part of this recent rise in the VIX has to do with the upcoming election, although I think that's the least of markets' concerns at this point. We're still going to put that in there because I think at the end of the day, it is a concern from markets, but it's not really top of mind. Today, we had news that Israel could strike Iran's oil facilities, which could send oil to new all-time highs, which the previous all-time high for oil was $140 a barrel. There's speculation that that could easily pass over $200 a barrel. Like, if you are long anything oil, you're going to make a lot of money, especially if you're trading options, and that does happen. That is like an economic disaster for the U.S. economy. We, with 100% certainty, would soon thereafter be heading into a recession. Okay, so talk about a disaster for oil markets. It would also be a disaster for the economy and disaster for the soft landing thesis. So you have those two things working. You have the port strike, which the port strike is an economic disaster as well. That's already happening. The longer that goes, the worse off things will be. And it's one of those gifts that keeps on giving, because even if the strike ends, you're still going to have problems for a while. And with the port strike specifically, I think it's one of those things where it just will slap Wall Street in the face one day. One day, a company will come out and say, we're going to miss on earnings. We're going to have to lower our guidance because of this port strike. And then Wall Street will start all of a sudden, literally flip of a switch, start worrying about the port strike. But just know, each day that port strike goes, which is now what, going on the third day today, it becomes an economic disaster within just a couple of weeks. And you could have 10 months of a backlog in the ports if this thing goes just a couple of weeks. Okay, so those are three things that are currently weighing on our markets that are massive events that markets are trying to kind of hedge for. This is one of the reasons why here on this channel, I haven't been hedging my portfolio the way that you might think, but I've been hedging my portfolio in a way that you may not think as well, by having a lot of cash. Having a lot of cash is kind of like hedging your portfolio in a way, because you're not exposed to the downside in cash, and you're able to take advantage of the downside when it does come. At this point, under the weight of all of these macro events that are happening, it will cause markets to fall. You will see a sizable, quote, volatility event in October. It could be after October. You know, the port strike and some of these other issues are not just an October problem. They could be a bigger problem in November and December ultimately. But these things will catch up to markets. And I think that's why you're seeing a lot of that hedging activity. Now, Goldman Sachs also went out today on X and sent this to their clients that you should be buying any dip that we get in October. And generally speaking, I agree with that. If we do get any kind of sizable dip, it's probably a buying opportunity, at least an area you want to start legging in. But there's this notion that markets will just bounce back after the election. I find this problematic because right now, again, you have a port strike, economic disaster. You have a Middle East crisis, economic disaster, if the oil fields are actually targeted. But just leave out the Middle East for a moment, which that could be the biggest event, but leave that out for the sake of this argument. Just with the port strike, that is an additional uncertainty that is going to be with us for a while, for weeks, if not months. So normal election years, like you get some election fear before the election, that's the main issue markets are dealing with. Right now, the election is not the main issue markets are dealing with. It's kind of like a sideshow here. So to sit and say that markets are just going to have this seasonal rally like they normally do after the election, I think is kind of misleading. Again, because normal election years, the election's the main story. This time, the election is not the main story. It's an afterthought compared to the port strikes and compared to what looks to be a pretty bad Q3 earnings season. Let's throw that in there. Let's throw in the, geopolitical tensions and the rise in oil that we could see. Again, these things take bigger precedence over the election. So I do find that troubling or problematic that people think that markets are just going to ferociously rally into year end with all of these other issues going on just because the election is over with. I don't think that's the case. Now, you can also see on a technical basis, the S&P is starting to curl down. Now, typically when you get this curled down action, you do tend to see bigger volatility come in. You tend to get those larger down days, those gap down days, if you will, before things are said and done. So I do think on a technical basis, markets are definitely showing signs of potentially a larger drop could be coming. That individual on the clip that you just listened to said that the August lows could be in play, which is about $509 on the SPY. That would, from current levels, represent downside of about 10.3%. From our all-time high at almost 575, that would represent a round trip of 11.5% downside. That would be a good area to start buying, I do think. But it really depends what the economy is doing, and it really depends, soft landing or not. Just, again, even with the port strike, if that thing lasts a couple of weeks or a month or two, you're going to be in an economic shit show. And I don't know if that would be the best time to buy the dip in an economic shit show. Now, coming tomorrow morning, we have a massive catalyst, okay? We have non-farm payrolls and the unemployment rate. I'll break that down in more depth in just a moment, but consider this. All of your economic data points we have gotten over the past couple of weeks, they've all been bad. Manufacturing employment came in bad. ISM services employment came in bad today. Look at employment. Came in at 48.1. The first time this thing has been negative since December of 2023. Well, I guess not the first time it's been negative. It was negative in June, in May, in April. But this is way worse than you were expecting. Okay, this is kind of like plummeting, right? And definitely continuing that downward trajectory that does not signal good things for the employment market. What'd you have today? Initial jobless claims that spiked a little bit, not a big deal. Challenger job cuts that came in at almost 73,000. These are planned layoffs. Typically, companies are not planning layoffs in September. Typically, companies are starting their seasonal hiring in September. This is pretty abnormal from that regard, okay? Last October of 2023, you only had 36.8 thousand Challenger job cuts. I mean, I don't see us plummeting again for next month, okay? So normally you see this spike January, February, March. After the holiday shopping season, that's when companies plan layoffs. Not before the holiday shopping season. I think that is problematic. Now, the ADP employment change, the private payroll report that we got yesterday, did come in better than expected if you factor in the seasonal adjustment. So the seasonal adjustment pushed it to 143,000 job ads. But if you look at the raw numbers, you actually had 260,000 jobs that were lost in September. That's not painting a very good picture. Okay, with that said, non-farm payrolls for tomorrow are expected at 140,000. I think that's a pretty generous estimate. Would it surprise me if seasonal adjustments or some wonky, editing of a spreadsheet would cause these numbers to come in higher? I wouldn't be shocked. But there is a good chance that you could also miss to the downside, and maybe Wall Street already knows that. Maybe that's why the VIX is spiking so much today, now up 7%, right? Maybe that's why there's been this flight to safety or flight to protect your portfolio over the past month or so. Couple of weeks specifically. Over the last week, volatility has really picked up in the VIX. Maybe it's because someone already knows the jobs report's going to come in bad. Who knows? I think the bigger thing the markets will care about is the unemployment rate. And here's where things get weird. Last month, the unemployment rate actually fell. It fell by 0.1%, including the roundings, hence the air quotes. You actually went from 4.26% down to 4.22%. You fell 0.04%, 4 points. If you rise 3 points from 4.22% to 4.25%, you get rounded up to 4.3%. So even a 3-point rise in the unemployment rate is going to look like 0.1% on the headline, and that's what the algorithms are going to react to. The bigger problem could be if the unemployment rate goes up, to 13 points to 4.35%, then you get rounded to 4.4%. And that would really spook markets. So a relatively small increase in unemployment could cause us to miss the estimate, okay? Miss the 4.2% estimate. That's what Wall Street is expecting, a flat, unchanged unemployment rate. And, just something that's like 0.13%, 13 points, could cause us to jump 0.2 on the unemployment rate. And that's really what Wall Street is going to be paying attention to. Now, if non-farm payrolls are expected at 140,000, if they come in around 120,000, I would expect 1 to 2% downside on the S&P. 1% downside, really not a big deal, would put the S&P back to about 561. 2% downside would put the S&P back to about 554. Now, if we come in less than 100,000, let's say 70, 75,000, somewhere around there, you're going to fall 3 to 5%. 3% downside would be back to about 550. 5% downside tomorrow would put the SPY back to about 539. That's my expectation. I do think this will be a massive event for markets. This is the first jobs report we've gotten since the Fed has cut rates 50 basis points. And I think all eyes are on this. I don't want to speculate too much, but given you've already seen the markets start to curl and roll over, given you've seen volatility has already picked up and has picked up before anything really happened, perhaps Wall Street already knows this is going to be a bad jobs report. That's just speculation, but it's worth considering. Now, for Tesla stock specifically, Tesla was down over 3% today. Not a great day for Tesla. Part of this has to do with the delivery numbers that did not impress investors yesterday. But, I mean, is that really a big deal at this point? I don't think so. I think they were good enough. And I really think it's just the volatility in markets, the hedging in markets that is really causing Tesla to fall. I don't think it's Tesla specific at this point. I think we've digested that delivery number. Okay, so what does this mean for Tesla? If we do have a risk off sell-off in markets in October, Tesla is going to fall. Tesla's not going to like that. Okay. Now, if we have a good market, I think Tesla can accelerate into October 10th. Now, I will tell you, for the Tesla bulls out there, the lower Tesla falls into October 10th, the larger the rally I expect after October 10th. Again, as long as we're not in a recession, or there's no crazy recession fears, or oil's not $200 a barrel. If oil's $200 a barrel, forget it. Tesla's going to not do bad. Everything's going to do bad. We're going into a recession, okay? At that point, there's nothing Tesla can do. But minus any major negative event, I think Tesla still can do okay here. And I think Tesla will do even better after the Robo Taxi event. So just sharing my thoughts here. Let me know what you guys think about this down below in the comment section. I did make some hedges today. I did make some trades today. If you guys want to see those, check out that link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.